Hey guys, Dave with Moniology here. Hope everyone is having a great weekend. Today is June 30th, 2019, and this is Charts Around the World, monthly edition. With the end of the second quarter and monthly charts in, we want to take a look at a perspective that's much broader than what's often reflected upon in the overall markets. And I want to look at charts from a multi-year perspective to give us a better perception of what's taking place. So let's take a look at what's going on in the world today. So starting with the S&P 500 here, as you see, we're breaking to new highs, and it looks very likely that we're going to be breaking out of this trend line here and moving higher. I still want to point out from a broader perspective, we're still creating very strong negative divergence, and I think at some point that's gonna not work out well for the markets. But in the meantime, there's a plenty of evidence to suggest that the markets want to move higher, and this is just one of them. Where every time you're breaking, you're hitting this trend line, you're kind of getting hit back, but you've got moving average support underneath you, and it looks like now that this is going to break higher, and we're going to make a run for that 2,300, rather not 2,300, 3,000 area in the S&P 500. Here's the Nasdaq as represented by the triple Qs, and the wedge is ever tightening, but it seems like it still wants to move higher. Again, here's this negative divergence where momentum is not as high today, anywhere near as high today as it was in 2017 and 18, but sure along it keeps plugging and chugging away, and it looks like we're very close to making new highs in the Nasdaq. Here's the Dow Jones, and it's making new highs, and it looks like it even wants to break out of this downtrend in momentum. So that's very interesting here on the Dow Jones. Here's the Russell 2000. Russell hasn't been as strong as the three major indices of over the last couple of months, but it has found support at the 50 RSI zone, and it looks like it wants to break higher. Now it's not firmly, but it's certainly above the 9 and 18 month moving averages, and so now it probably is going to make a run towards that double top area of 170 on the IWM. Here's European developed markets, and actually not European, just developed markets in general, and it looks like after bottoming at the 3650 area, we are going to make a run for that 45 zone again. So there's quite a bit of upside still left in European markets, but again, still quite a bit of negative divergence, so something just to be aware of. But in the short term, I think that there's significant upside. Here are the emerging markets. Emerging markets have been one of the better looking charts from a longer term perspective, even though they haven't done anything from basically 2010 all the way to effectively 2017. They were consolidating, but it just looks like they're just setting up there in a coiling pattern, if you will, for a multi-year breakout. And once we break out of this zone around 44, we're certainly going to make a run towards that 50 area. But once we break out of there, that's where you want to be in emerging markets for maybe 3, 4, 5 years, where you can see 100% returns for several years. So some really significant upside here based on this chart alone. Here's crude oil, and crude oil is, I pointed out in last week's chart, looking at various oil sector, oil and energy gas ETFs, that they've started to bottom, and they're starting to really look positioned for several months, if not years, of very positive returns. And so crude oil here right now, we closed the month at around 58.50, right along the 9 and the 18 monthly moving averages, and right now it's in a range between 40 and effectively 70, but it looks like we closed the month just under the 50 RSI level, and as soon as we break higher, I think we're going to have some very strong momentum to make a run towards that 75 area, and at that point we'll have to revisit what it wants to do. But in the short term, there's some, when I say short term, looking at monthly charts over the course of, let's say, 20 years is not short term, but I'd say over the next 12 months, crude oil is well positioned for more upside. Here's the Chinese, the Shanghai Composite, and you see here that it's been in a downtrend since effectively 2015 and starting to break higher. So despite a lot of these conversations about trade wars and how it's impacted China, the markets are starting to build momentum that's going to take us probably towards that 3,700 area and possibly as high as 4,600. So there's a lot of upside should this confirmation be breakout rather be confirmed over the next couple of months. The Nikkei, the Tokyo index, this one's consolidating, basing between 20,500 and 23,000. I think it's going to make a run for that 23,000 pretty soon and perhaps break out higher. And it's finding this support around that 50 RSI level, which is very important. And I think it's just going to tag along with the rest of the markets. Here's the Canadian market. So Canada is building higher highs and higher lows. And so this is a very positive development. And you've got the negative trend in momentum, sure, but it looks like it wants to break above that trend. And if it does, that would be very bullish for the TSX. Obviously, Canada is very, very much into heavily weighted in commodities, gold, energy, and so as those sectors do well, Canada might be one of the best markets, general markets to invest in. And notice again, you've got the MACDs now above zero, and that's another area of strength. Now you've got the USD monthly, the US dollar. It couldn't break above that 98 zone, and I pointed that out in many charts that the dollar looked like it was topping, and now it looks like it's rolling over, giving us further confirmation to our point of view. Looking at momentum, this was just an inflection point of multiple trend lines, and we couldn't break above it, and now we're on the verge of breaking below the 50 RSI. And if that happens, I think you're going to see a sharp move down towards that 90 area, possibly 88. And when that happens, that's when you're probably going to see gold making a move towards that 1800, 1900 area, retesting all-time highs. So very, very positive development for precious metals and negative for the US dollar. Not showing in this video, by the way, the Australian dollar, the Swiss dollar, and the Canadian dollar are all and the Japanese yen are all looking very strong against the USD right now. So if you're into currencies, those are areas that you might want to take a look at. Here's the 20-year bond ETF. So this does well when interest rates go down, and so it's just showing you that since 2007, basically interest rates have been dropping, and obviously the 20-year ETF Treasury has done really well. And you've got upward sloping moving averages with the 9-month crossing over the 18, and so that's just further credence to the bullish argument on bonds and bearish on rates. You see that breakout here, so we might have a retest, we might pull back some, but ultimately we are in an uptrend in bonds and a downtrend in rates right now. Here is the real estate ETF, and real estate has done really well. When you lower interest rates, real estate will do well, and sure enough, it's one of the better performing sectors this year, and its momentum is poised to continue moving higher until hit by a brick and sent in the opposite direction. Here is the financial ETF, and this one looks really strong too. It's consolidated here for a better part of 2 years, so it hasn't done much if you've owned it, but now it's starting to look like it wants to break higher and bring on a new leg to the upside. So, and you've got the MACDs that are still below zero but curling higher, and I think that once it breaks 29 on the XLF, that's your trigger to go long for a new leg higher. Here are the home builders. Again, home builders have broke out of this downtrend that it was basically in since 2013. We did that in 2017. We back tested a couple times here in 2018, and now we kind of moved higher, not really looking back. I think home builders are very strong here. We're certainly going to make a run towards that 44, which is a nice percentage gain, but once you break above that, that's going to be the next leg higher in home builders. Technology ETF, that one looks strong as well. It looks like it wants to break that 78 area on the XLK, and if it breaks that, we'll probably make a test towards that 70 RSI level, and if it break that, then that's going to be incredible upside. But obviously it's had a very great run, and looks like it wants to move higher ever more. Here is home construction, just another view of real estate, and yeah, it wants to make a move back towards that 43 high that we created in 2017. It's back tested that 50 RSI level, and it's ready to move higher. So like home construction, home builders, here. Here's one of the most interesting charts of this watch list. This is solar. Solar on a monthly level basis is breaking out. You're seeing a breakout here in RSI moving above that 61 level, Fibonacci RSI, and it's breaking above the previous tops. And so that's suggesting that, I mean, we're at 28. I think we're going to make a run towards that 40 level, which is a considerable gain to the upside. And then we'll see what happens there. But solar is a very, very fickle sector, and it hasn't done much of anything from 2012 to about 2019 for 7 years. And here we are right now that starting to make a move. So I like solar here a lot. Here's Dow Transports. This is an area that you want to see doing well if the economy is going to be strong, and it's starting to move higher and looks like it wants to make a break above that 195 area to new all-time highs. So I like Dow Transports here. Here's steel. Steel is also looking like it wants to break out above this downtrend, and it's making a double bottom move towards a break above that 50 level of RSI. So I like steel. With the overall economy, home builders and so on, this is an area that you definitely want to consider, and certainly some of the underlying names. And we'll look at them over the next coming weeks and months for long positions. Here's the XLE monthly, the energy ETF. It hasn't done much, as I pointed out, over the last couple of years, and but it's now it's poised in position to make a run towards 70 and perhaps higher, perhaps even a move towards 85. So I like the XLF right now. It's been beaten down, and it's making a move. It's created this momentum under that 50 RSI level. Once it breaks above that, that's going to be your trigger to really go long, and that's when it's going to take off. Here is the high yield bond ETF, and this is one of the better barometers for the economy. And high yield, even though it's been creating negative divergence, it just looks like it wants to break above this 69 level, which is going to serve as very strong resistance. But if it breaks above that, then I think the idea that a recession is around the corner will be put to rest. But if it pulls lower again, then that's a different story. The European financials, they too are just building higher highs and higher lows in RSI right below the 50 level, and looks like it wants to break higher. So if it can break above that 19 level, then it can make a run towards that 23 level. Another sign that the global economy might be turning to the upside. Here's the Uranium ETF monthly, and it's been coiling here for quite a while, since 2017, and it looks to be on the verge of breaking higher. It obviously has to break above the 9 and 18 month moving averages that are right above it, around 1216, 1246. It's got some work to do, but if it breaks out above it, it's got tremendous upside towards that 17 area, and it could go to 22 and all the way to 30. Uranium, no pun intended, is an explosive sector which we are big believers in. Commodity index. This includes basically agriculture, precious metals, energy, all at one, and it's what you want to see when you take a look at inflation, global inflation, and it's been getting killed obviously for many years. Hasn't done anything since effectively 2018, and once this trend changes, that's a multi-year trend that you really want to ride. It coincides with emerging markets doing well, and it looks to be on the verge of making that break higher. It's very close to that 50 RSI level that it's going to take out, and if it does so, you're going to see a lot of upside in commodity names. We're talking 10 times returns. Here is the very, very important 10-year versus 2-year Treasury ratio chart. This is basically when you hear of an inverted yield curve, this is what we were headed towards over here. This is the 2-year starting to outperform the 10-year. And or in other words, the 10-year rates dropping faster than 2-year rates. And at this point, we were very close to a 1-to-1 ratio, where the 10-year and the 2-year were same rate, And if we broke below that 1 area, that's the inverted yield curve, and that's where the recession risk is high. And but sure enough, we found support here, and now the 10-year Treasury is starting to move. The 10-year rates rather are starting to move higher versus the 2-year, which suggests that at least in the interim, next couple of months, there's no sign of a recession, and there's just a lot of momentum towards more bullish developments in the market. All right, so here's gold. Gold monthly since 2005, as represented by the GLD. Obviously broke out here this month, and momentum is very, very strong. Broke out of a multi-year consolidation, and so you're going to see some significant upside. The question is how much and how soon, not whether it breaks out. It's already broken out, and if you have the patience, you're going to see some tremendous gains in the underlying miners. Here's gold, the actual gold chart, and you see here breaking above that 1400 level was so crucial. You got momentum leading this breakout, and this one is for real. This one is for real, guys. And I would say 1700 to 1800 this year is not outside the realm of possibility. Here's gold versus the S&P 500, a ratio chart, and we've been underperforming, or rather, the S&P has been outperforming gold since 2012, and that's changed right now. In 2018, we broke out of that downtrend and we back tested. Now we're moving higher again, and I think very soon you're going to see a rapid acceleration of gold versus the S&P. Whether gold moves higher or S&P is flat or S&P drops, we'll see how that plays out. But this is the area that you want to be in. Gold is definitely going to be shining metal soon. Gold miners, but the majors, you see here, they broke out of a bullish wedge and now are firmly rising. The next logical price target is that 30 level. Once that breaks, I mean, there's so much blue sky towards 51, possibly 60 could be hit this year or early next. So there's tremendous upside in the miners. Here are the juniors, same thing, broke out of this wedge, and it looks to be making a move towards 47, and then you see how far it's fallen. I mean, you can see a move towards that 80 level this year and perhaps much higher thereafter. And finally, on this watch list is the global gold index, and just to give you a different perspective, firmly above the 50 RSI. You notice even as it was consolidating, it was making higher highs in momentum until here, where it really shook people out. And this really tested one's patience, but it quickly recovered, and now it's firmly moving into the positive direction. This is an area where it last found resistance right around here, around the 60, I'd say 68 level. We might find some resistance there. That might be our pullback and consolidation point, but that might not happen until we hit 290. So a lot of upside. MACDs are firmly above zero, and I love what I'm seeing here in gold in general. So overall, markets are starting to act bullish, and this is on a global level across the board. I recommend looking for sectors that have been beaten down over the last couple of years that present a better risk reward, but everyone's got a different approach. I'm more contrarian. A lot of folks are more momentum. So great opportunity for the option buyers to buy calls and perhaps bull spreads and various other opportunities that we'll discuss in future videos, or just buy the underlying ETFs or the underlying names in those sectors, because they're going to do much better, especially if they're leveraged to a commodity. So anyways, guys, I really appreciate your follow and your support, your retweets. Check us out if you haven't already done so. Twitter, StockTwits, and YouTube at Moniology. And keep in mind, we are launching our new premium investment service for those of you who want more in-depth videos like this one. This is for you, but there's going to be a lot of free content that we're building out, and I really encourage everyone to be a part of this community that we're trying to build here. And for those of you that you can, the premium service really will help support the content that we're trying to create and the community that we're trying to build. It's not free. It costs money to put this together. It costs obviously a lot of time, and your support will be much appreciated. And thanks again. Have a great week.